Welcome back, everyone. I'm Christopher Ludwig. Welcome back to what I'd like to call here our London Library studio. Over the past 3 days of Automotive Logistics and Supply Chain Live, we've explored many aspects of the challenges faced by the global automotive industry and supply chain in the midst of crisis and transformation. Now, we'd like to take a deeper look at the trends and driver influencing the North American market. The US has been the epicenter of the crisis and is also facing a challenging election year. And the vehicle market has certainly taken a hit. But the resilience of retail sales and indeed the supply chain have in many ways exceeded expectations. But how long will that continue? The market is also in a rapid state of change. Witness, for example, GM's recent alliance with Honda and with Nikola, newcomer Rivian with Ford and Amazon, and many other new players and partnerships, all of which will reshape the market and supply chain further. Here to discuss the outlook and dynamics of the North American market and give us some global context too is Brandon Mason, an expert on vehicle production and sales analysis, who's today lead analyst for global market intelligence in Eaton. Brandon, it's great to see you again and to join me today on the virtual stage.
You as well, Chris.
All right, thanks. Look forward to talking to you after. We'll hear from Brandon for the presentation, and then we'll come back for some Q&A.
Great. And great to be with everybody virtually today. Looking forward to hopefully a good overview that you'll find enlightening and informational, and then we'll have a good discussion, hopefully during the panel discussion later.
Absolutely.
So as Chris said, I'd like to start off, and we're going to go through a little bit of the global outlook, and then we'll drill down to the North American market and where we see things headed. You know, and I would usually put these slides at the end, but I think it's important to just take a step back and realize where we're at in the world today, right? I don't think anybody can argue the socioeconomic impact that COVID has had on the world that we live in. It's been drastic, it's been quick hitting, and it's been severely impactful. And we're all sort of living through it. So to that extent, I hope that everybody is managing it okay, and everybody is staying healthy to the extent that they can. I would say that at a high level, we've started to see some markets stabilize, which is certainly a good sign, but other markets continue to struggle. And I think over the next 3, 6, 12 months, we're going to continue to see a lot of fluctuation in markets as that uncertainty reigns. And I think that while we expect to see some levels of normalcy return in the near term, I do think we are going to be living in a new normal going forward, where things will have fundamentally changed for the foreseeable future. All right, let us get into a little bit of a quick run around the world, providing a quick outlook. So the U.S., which I mentioned we'll get into a little bit later, August sales were down 20%. The market here is starting to show signs of stabilization. I think over the last couple months, the sales numbers have been encouraging, still have a long ways to go. Brazil is an example of a market that is still a little bit trying to find that level of stabilization. Sales were down about 25% last month. We're expecting full year sales to be down about 30% in that market. They have really yet to, I would say, hit that stabilization point. However, we do think that next year will be a particularly good rebound year for that market. In Europe, and if we take a look specifically at Germany, the impact of the value-added tax reduction hasn't quite had the impact that I think they expected it to. So July sales were still down 5.5% year over year with the implementation of that VAT reduction. August sales then returned to another level of decline, down 20%. Europe, we try and be careful with Europe because we've got so many dynamic markets that we often like to lump together. There was a very diversified approach to how to incentivize that market. Germany, for example, focused mainly on incentivizing plug-in and electric vehicles to the detriment of internal combustion engines. Other markets within the European Union chose to take a different route. So it's a very, I would say, uneven recovery in some cases in that market. But we do expect that market to gradually recover, but we'll get into that here in a moment as well. I think that market will struggle to recover to the levels of some of the other mature markets. And in China, if we think about, some good news, the Chinese market was up 11% in August. I think that, that market, having been on the leading edge going into the global pandemic and recession, has also been on the leading edge of recovery. So while we expect that market to be down for the full year about 12%, and that will actually mark the third consecutive year of sales declines in that market, we do see very strong growth going forward. And I think a particular note, and I don't often talk about it, but the commercial vehicle market in China is on pace for a record high, driven by significant government stimulus and infrastructure. But still, some very good news coming out of China in terms of overall product demand. So when we talk about the new normal, one of the things I want to kind of emphasize here is this permanent downward shift in production. I think if you look at the early days of the pandemic, and I mean March, April, when it really started to affect the globe, a lot of people were cautiously optimistic that we would see somewhat of a V-shaped recovery where, okay, we would have a sharp downturn this year, we would have an extremely strong rebound next year, and basically continue upon the normal path that we had forecasted prior to the pandemic. That simply turned out not to be the case. If you look at the IHS Global Light Vehicle Production Forecast, the chart on the left, the gray line shows what the top line forecast was in January of this year versus the most recent forecast in August. So it is this permanent reduction in our top line over the course of the forecast window. If you were to look at the loss, if you just kind of add up all of the black lines there between 2020 and 2027, you're looking at 70 million units less of forecasted production over that time period. That represents about a 9% reduction over that same period. That is a significant amount of vehicles. So this is not an instance where we're going to have just an immediate return to normal. We're going to have this continued downward trend, and we're going to have to deal with this new normal. And again, some markets will recover more quickly than others, but it's important to note that, this is not an instance, and if you compare it, which I will do often over the next several slides, comparing this to the Great Recession that we had a decade ago, yes, that was longer, or at least we hope it will ultimately end up being longer. But, we had a strong rebound after that, and we hit, record sales levels here in the US, record production levels globally. It's going to take a longer time to do that. And so if you look at where we're at today with the outlook, we're not expecting to hit those pre-pandemic levels again until 2024. That is a very long time from now. So this is something that the whole industry is going to have to adjust to, this lower level of global production. Again, as I mentioned, the market dynamics here are a little bit interesting as well. So if you look at the red bars, this is essentially the walk down in global light vehicle assembly from 2019 to 2020. That's that just over 20% decline in the market. And then going forward from 2020 to 2027, we've got a 4.7% compound annual growth rate, and it shows you the walk back up. So I mentioned Europe earlier. That's a good example of a market that we don't see, is not seen to recover fully by the end of the forecast window. So losing over 5 million units from 2019 to 2020, and only recovering 4.9 million units of that volume from 2020 to 27. Some of that is, uneasiness about the long-term economic outlook in Europe. Some of that is regulatory driven. If you think about emission standards and what that might ultimately do to the price of vehicles. Other markets like China, as we said, over the last couple of years have struggled a little bit, relatively speaking. We expect to see very, very strong growth over the forecast window. So we're growing by over 8 million units in the next 7 to 8 years. So again, it's a bit of a mixed bag when we think about, the markets that are suffering today versus the ones that will recover more quickly and see that growth throughout the forecast window. All right, let's get into North America then. And I have to say, we've all seen these headlines, and we're fighting, and it's not just unique to the U.S., right? Every market is fighting their own battles and have their own unique challenges related to COVID and production and unemployment and things like that. But I have to give a lot of credit to the OEs and suppliers out there. When we were hitting the depths of the downturn here, April, May, when all the plants were shut down and we started to talk about when are these plants going to open back up? You could have asked anybody, any of the experts in the field. I don't think anybody would have said that we would have seen this level of performance coming out of the plant downturns for that long, or the plant shutdowns for that long. I mean, plants were down over 2 months. There was serious concern that there was going to be huge gaps and breakdowns in the supply chain. And we have seen isolated examples of that, don't get me wrong. But by and large, the supply chain has held very strong. So we're not out of the woods yet, but we've been very impressed with the strength of the supply chain in North America over the last few months as we've ramped back up, essentially from a screeching halt for 2 months to ramping back up and now trying to actually keep up with demand in some cases, which has been equally as impressive. All right, so we're going to talk a little bit about the overall economic outlook here, and then we'll get into some of the industry-specific measures. But I think it's also important to mention before we get into all the economics that, we're going to see a lot of shocking numbers, particularly for Q2 here, just because of the impact of it was so immediate. When we basically turn off large swaths of the economy, you're going to see some pretty shocking numbers. So I think it's important to, one, keep that in context, but it's also important to think about that the length of any given recession is just as important as the depths of the recession. If you look all the way back to the Great Depression, that lasted 10 years. That was a significant impact. If you look 10 years ago to the Great Recession, that lasted about 18 months. As we sit here today in September of 2020, we're 6-7 months or so into the actual recession. How long it will last, we hopefully not much longer. We'll get into that in just a second. But I think it's important to note that it's how we move forward from here that's going to ultimately determine the massive impact or the potential massive impact to our industry. So if you look at GDP here, for example, the Q2 number was pretty shocking. And the annualized rate, it dropped 33%. That's the largest in history. Okay, but again, if you think about what happened during Q2, that shouldn't be all that surprising. The good news is the outlook is progressively better for the rest of the year. So again, if you just looked at that from a month-to-month basis, the GDP shrank 9.5% from April to June. Still the largest in history, but just for some context there. So the outlook for Q3 is marginally better, and then marginally better again in Q4. And we expect, sometime in Q2 or so of next year that we'll start to see some positive growth in the economic outlook. So, it's, again, take it in context. At first glance, it might be like, oh, wow, this is significant. And it is. But it really is also important to think about what is the path of recovery. As I mentioned, I don't think we're going to see that V-shaped recovery. We're probably going to see more of a U-shaped recovery. But it's also important to note that we still have significant challenges that lie ahead. And the overall economic outlook and consumer sentiment and everything we talk about is still fundamentally tied to the ability to create and distribute widely a vaccine to COVID-19. I think until we start to see some clear movement on that and a clear definitive time frame, we're going to continue to have certain levels of uncertainty in the economy. All right, let's look at a couple other areas here. So unemployment rate and personal savings rate, two items that are very closely tied together. Again, April was a bit of an anomaly, come in at 14.7%. That's actually not the highest we've had all time. During the Great Depression, it was just over 25%. But some of that, again, context is important. So we talk about, the immediate shutdown of the economy. And so a lot of folks were temporarily laid off. We then had the federal unemployment stimulus package come in that was offering, in some cases, up $600 per week in subsidized wages for some of these workers. So in some cases, there was a reluctancy to come back to work. So it's a little bit of a couple things going on below the top line there. The good news, though, is that since April, we've seen the overall unemployment rate continue to trickle down, and as we sit here today, it's at 8.4%. Still, again, historically high, but if you look at where that was at compared to the Great Recession 10 years ago at 10%, it doesn't seem all that bad. So the numbers tend to be trending in the right direction. Same thing with the personal savings rate. So this is essentially your percentage of savings versus your overall disposable income. It obviously spiked back up because a lot of people lost a lot of their disposable income as those unemployment hit and things like that. So again, still trending down, still heading in the right direction. And I think the next one we'll look at is the consumer sentiment index, and I think this is good news on a lot of levels. So one, yes, it dropped, but we never dropped to the level that we saw during the Great Recession in 2010, where we were down in the 50s in terms of where the index was at. I think we've stabilized somewhere in the low to mid 70s right now. So stabilize is the key word there, right? If we can stabilize and start to crawl back up in terms of where consumer confidence is at, that's big. Again, remember, consumer spending accounts for 70% of our GDP. So if we have confident consumers, that gets us a long way back to that overall economic recovery. And again, when we talk about light vehicle sales here in a few minutes, we'll see that because the light vehicle sales have actually been very impressive despite all of the challenges that the industry has had. All right. So let's move on to some of our industry-specific indicators now. U.S. light vehicle inventory. Again, I harken back to the days of the Great Recession, and for folks that lived through that, we remember that we had the plants in the U.S. and in North America shut down for an extended period of time as well. But that was also driven by the fact that we had very little demand for those products. It was more of a demand-driven instance versus a supply-driven instance. In this case, the factories were forced to shut down. People still wanted vehicles. I was actually shocked when we got April sales numbers and they were only down 50%. I thought they would have been down much more than that, again, because much of the economy was shut down for the entire month of April. So one of the challenges that we've had, while we had to shut down plants for 2 months, but demand stayed high, we had a significant drop in inventory. You see on the chart there from March to May, we had a 32% decline in overall inventory. So we're at 2.6 million today, right about where we're at in May. And so even as plants have started to come back online, we haven't really seen a big increase in that vehicle inventory because demand has stayed high. And also we're still not back to full production rates. And, we've seen various announcements from the OEs talking about, well, when do they anticipate getting back to pre-COVID levels? I think that's a difficult proposition. I think we can get close, but I think that's a difficult proposition here over the next 3 to 6 months. Just taking into account, again, still uncertainty in the supply chain, right? It's held so far, but if we have breaks in the supply chain that are not, that are not forecasted, if we have further outbreaks, and even the safety measures that have been put into place in a lot of these facilities has fundamentally limited the amount of capacity for some of those facilities. So I think you're going to see really, really limited inventory for the remainder of the year. I think we'll see an incremental increase in the overall number, but not much, so long as those demand numbers stay high. Okay, and likewise with light vehicle incentives, many of you may have remembered in the early days of the pandemic, March and April, we saw a lot of really lucrative financing and incentive options out there. 0% for 84 months, payment deferment of 4 months or longer, a job loss guarantee. If you lost your job, you wouldn't be responsible for payments for a certain period of time. Well, consumers took note of that. And, I think a lot of the captive finance companies had to quickly change their tune a little bit. You see in April, we peaked out at over $4,300 in average incentives per vehicle. That is a record high. I don't think we're going to see that for the rest of the year again, just because there's not enough inventory to kind of to justify that level of incentive. So I think we'll probably see tapering off of incentives for the rest of the year, maybe a little spike in December like we most often do. But that 4,300 number, we might not see again for quite a while. All right, so light vehicle sales. So here's where we are at today. For the year, we're expecting sales to be down from 17.1 to 13.6 million units. So, around a 20% decline, which is on par with the overall region. So not awful. And again, we're kind of ending the year on a high note. That represents a 2.6% compound annual growth rate over the forecast period. But, we have some folks that felt that we're going to rebound. Again, I said this before with some of the overall economic indicators that we're going to rebound and, the next couple of years we'll see pre-COVID level sales. But folks, just think about, look at from 2015 to 2019, the run that we had. That is a historic run, 5 straight years of more than 17 million units of sales. I don't think we're going to see that not only in this forecast window, but maybe ever again. That is a massive number. So while we do see continued incremental growth over the next several years, I don't think we're going to get back to that 17 million unit number. And again, keep in mind, in the US, I think people often forget this, that fleet sales, so rentals, taxi cabs, municipal vehicles, et cetera, makes up 20% of total light vehicle sales. And we all know what demand rate now is for some of those. If you think about folks, unwillingness to travel or investment in infrastructure, things like that, I think the fleet numbers can continue to suffer for a while. So while retail demand may come back sooner, I think that fleet number is going to continue to drag down the overall top line for quite some time. So important to keep in mind when we think about fleet as a percentage of total sales, because that's going to have a big impact on that top line number. All right. So what does that mean for light vehicle production? So, if we looked at top line sales, we said, okay, we don't see sales getting back to pre-COVID levels within the forecast window. We actually do see that on the production side. So we think production is going to be down a little bit more versus sales this year. Production for the region will be down around 22%, increasing to 15% in 2021. So we get back to those pre-COVID levels by 2025. But then we continue to grow. So I think there's a couple things that are really driving that. So if we think about the trade agreements that are in place, the uncertainty with the US-China trade situation, I think you're going to continue to see more localization of product and the subsequent supply chain into the region. So more build where you sell. And I've talked about this before, but I think that's only going to accelerate. And I also think you're going to see an increase in the non-NAFTA exports from some of the automakers, particularly those in the Southeast that are global production hubs. Those two things are really going to help. And we also talked about trying to build that inventory level back up. So those things are really going to help accelerate the top line recovery compared to sales. Okay, so, maybe a year ago, all it seemed that we were talking about was CASE, and the CASE acronym is becoming a little archaic. I think we'll probably see that evolve, or have already started to see that evolve. But I thought it would be interesting to look at what is the impact, or what impact has COVID had on the investment in the development of these various technologies. So just quickly walking through, if we think about connected vehicles, whether that's V2V, V2I, infotainment, et cetera, I think that trend will continue, but I do think there's going to be let's call it a slowdown in the investment or the implementation of some of those technologies into vehicles. Again, think about the dollars, that have been lost. We talked about those 70 million units lost over the forecast period. That's a lot of revenue loss for the entire supply chain. So that is going to impact each of these technologies in a different way. Same with autonomous. I think that you're still going to have companies that are, let's say, all in on autonomous and developing L4, L5 vehicles, and that still will happen. But I do think it's going to slow down the adoption period, because you've got fewer companies that are able to invest as much as they were able to pre-COVID. I think shared vehicles is going to be the one that's the most impacted. So, again, if we think about what has COVID caused us, now we've got folks, wearing masks, and we've got hand sanitizers, and we're worried about airborne diseases much more than we were before this. This delayed adoption of shared mobility, this aversion to public transit or shared mobility, I think is going to have a big impact for quite some time. So I do think there's going to be a significant drop in the demand for that in the near term, but then also the rollout of that more broadly over the next couple of years. And again, we talk about this as a 5-year horizon. And finally, electric. I think electric, actually, to the contrary, is going to see an accelerated rate of adoption. So yes, a lot of that is regulatory driven, but if you think about the need for automakers in the industry to further consolidate platforms, I think we all know what the end game is, right? If the end game is we are going to live in an electrified world, why not speed up the consolidation and the rollout of those platforms to achieve scale? So I do think there's going to be an accelerated investment and adoption rate in electric vehicles over this time period. Okay. All right, and maybe just to sum things up, I thought I'd take a minute or two to just talk about what we're doing here at Eaton, in the spirit of letting no good crisis go to waste. I think that if we talk about Industry 4.0 and some of the main pillars of Industry 4.0, it's not that we haven't been talking about these developments for some time, but I think the practical application and the acceleration of implementing some of these technologies has certainly increased during COVID. We certainly have done that. The goal here is to improve operational performance, productivity, flexibility, quality, and speed to market, while obviously our overall priority remains keeping our employees safe in these facilities. So we've leveraged things like augmented reality, collaborative robots, free-ranging robots to help with some of these challenges that we're facing, because we can't always be together in the same place. So virtual training and things like that are also other things that we've been implementing and accelerating the implementation of over the last several months. And again, I won't go into all of these, but these are just some other examples of Industry 4.0, pillars and actions and technologies at work, which I do think we're going to see a continued acceleration of. So if we think about the new normal, I think, again, this will become a much more commonplace thing. And even as we sit here today talking virtually, this is, I think, just a preview of what we're going to see as the, quote, new normal as we move forward. But again, make no mistake, plenty of challenges ahead for our industry, but I do still see a very bright future for us as we continue to evolve and adjust to that new normal. So those are my comments. I appreciate your time, and I look forward to taking a couple questions either now or during the panel discussion. Chris?
Fantastic, Brandon. Thanks as ever for that great insight, even if it was indeed sobering in many ways, but an important analysis there, and as ever very thought provoking. So yeah, I thought we have a bit of time that we can go through some questions, and then later on there'll be the panel for further, so our audience will have some more time to address things then. Let's start kind of briefly on the vehicle inventory side, which I think is an interesting point. So clearly, some of those plants can't catch up everything right now. Do you think that it is having a material impact on the sales and sales potential in the market? And maybe an addendum is that I imagine it's not evenly spread. In other words, the shortages aren't equal across all segments, are they?
Yeah, that's right. And so the first question is, to answer your first question, absolutely, I do think it's impacting sales to some extent, particularly mid-size, full-size pickups, full-size SUVs, things that have long been in high demand. And some companies are even changing over. General Motors changing over to the T1 SUVs. I think there was a huge pent-up demand for that. So the ability to roll those vehicles out has been limited. So yes, it has impacted sales, I think, to some extent. And then yes, not all things are created equal. So some segments, passenger cars, et cetera, we've continued to see inventories remain relatively high. Others not so much as demand has dictated.
Yeah, absolutely. One of the things you mentioned about the obviously on the vehicle electrification and that potentially accelerating now in the US. Now we've seen that start to happen in the last few years in Europe and in China, not least on the regulatory side. So what impact do you think the regulatory side in the US might have? That being this being an election year, and clearly there's going to be a few question marks on that side. But do you see a fundamental difference in the years ahead, depending on the election outcome on this side?
It's a loaded question, Chris.
I'm always full of those.
That's right. To be frank, yeah, absolutely. Now, some things are more or less locked in place. If we think about the federal fuel economy rules over the next several years, the final rule has been passed on that, and that is what it is. To the extent that automakers want to voluntarily adhere to more stringent standards, like we've seen with the California Air Resource Board and the states that follow them, I think that is going to be potentially a big driver based on who was elected or reelected in November. As you might recall, right now, the goal was to strip California of that waiver to enforce those more stringent standards. If we have a Democratic administration, I think the idea would be to keep that waiver for California, which would then roll in more stringent standards for a large portion of the country. The California and the states that follow the California standard make up anywhere from 30 to 35% of sales for the country. So we could see a significant shift. But I think regardless, the automakers, the industry get it. They get where the future is at. So I think we're going to see an accelerated adoption of electric vehicles regardless, but I think it could accelerate even more depending on the regulatory environment that we see after the November election.
I think that's one can definitely see that if we look at things like what General Motors is doing with their rollout and investment plan seems to be well ahead of what we might see currently in the U.S. North American market. But you raised the point on the consolidating vehicle platforms earlier as a way to accelerate that. Can you talk about this is not a new strategy as such in terms of OEMs either building across fewer platforms and variating the top hats? What's different this time around, and why is it so important to the acceleration of electric vehicles?
Yeah, I mean, it's a couple of things. So one is really hunkering down on cost, right? If you have the more platforms you have, the more differentiation, the more cost you're going to have. And furthermore, if you're able to partner with somebody, a strategic partnership, joint venture, whatever it might be, you're able to cut cost even further around the development and rollout and scaling of those platforms. So I think now it's more important than ever to make sure that you're managing your costs effectively. On the electric vehicle side of it, again, scale is hugely important here, right? We've all heard the different reports around when are we going to hit a truly break-even cost. And we often talk about the batteries and the cost per kilowatt hour that power those vehicles, but the fundamental platforms are important as well. Achieving scale on those more quickly allows for further adoption and vice versa. So something has to give. We talk about chicken or the egg. I think the industry is focused on now about scaling up those platforms, and then costs will subsequently come down and increase share.
And I mentioned right at the top of the session the GM Honda collaboration announced this week. Obviously, Ford and Volkswagen already have a similar alliance on a global scale. Is this the shape of things to come? Is it on this alliance side, or perhaps even more direct consolidation?
Yeah, absolutely. You can't go it alone anymore. And I've been saying this for years, and, the industry continues to accelerate on those strategic partnerships and joint ventures. And, I think about us at Eaton and the things that we've done, right? I mean, for us to accelerate our market entry strategy, or, invest in new technologies that we weren't currently in, these are all positive things. And obviously the cost benefit on top of it, it is certainly a benefit. So I think all of those things combined will only serve to accelerate those partnerships. And if you think about overall industry consolidation, I still think it's inevitable, Chris. I think that we're just a few short years away from seeing it. And look, if you think about the events that have happened over the last 12 months in terms of some of these larger alliances and rolling up of alliances, I think that's just a precursor of things to come.
Absolutely. And in terms of the, an interesting trend that I sort of note is perhaps the age coming now of electrification of SUV and pickup trucks. And I wonder if, especially when we look at the US market, this has to be one of the things that might really lead to more of the big bang in terms of that adaptation, or is that less of a thing?
No, I think you're spot on, Chris. Look, we all know the demand for pickups and SUVs here in the U.S. continues to grow day by day, month by month. So, creating electrified vehicles that fit into those segments that there's high demand for, just makes prudent sense. And I would also argue, if you think about the margins on those vehicles and being able to be profitable for electrified powertrains, that's the way to go. Why would you build an electric passenger car if there's not high demand for it? Right now, some companies like a Tesla can charge higher margins, and that makes sense, right? And there's still demand for those vehicles. But if you're trying to make a mainstream product, why not build it in the segments in which there's high demand? So I think that's a smart move by these companies that we're going to see roll out of these electric pickups and SUVs. And frankly, I'm excited to see them.
Do you think the US or indeed with the role, if we look in Europe, we've seen the incentivization, as you highlighted earlier, tied in large part to low emission vehicles, Germany and Spain, for example. Right. Not the road necessarily the US is going now. Do you think that will be a potential important development at some point for the US in that sense? Or perhaps it's more the break even and more the right product mix?
Yeah, I think it's still on the table, right? And we haven't seen, for example, during the Great Recession here in the US, we saw the Cash for Clunkers program, right? Which had a huge immediate impact, but then it almost pulled ahead sales for the subsequent months and years. So, the analysis that was done on that program was like, well, did that really do a lot to move the needle? Sure, it had an immediate near-term impact, but what did it do for us long-term? I think that the initial push for that, or, renewed or increased incentives for electric vehicles, that moment is sort of past for the time being. Now, again, we'll see what lies ahead in Q4 and the months beyond. But so long as we've got market stabilization and are still seeing an incremental increase, I don't think we're going to see that level of incentivization like we have in some of the other markets.
Looking at one of the key factors in this whole transformation would also be the battery supply chain and the manufacture of batteries. Again, mentioned GM, big plans for a plant in Ohio, others taking different routes, not necessarily building in-house. Do you see a large localization of that supply chain also coming now to North America along the lines of GM, or still a more distributed model, let's say?
Yeah, I think there's probably going to be a lag in that until we truly figure out where the demand level is at, and can you justify, localizing content, because you still have to have critical mass. So while I do think there's a lag in that compared to other parts of the supply chain, I do think it will happen over time. We're just still trying to figure out as an industry what that timeline looks like before we hit that critical mass number.
Yeah, absolutely. Yeah, speaking of loaded questions, the USMCA, a bit out of the headlines at the moment. We did have an official ratification over the summer. Is that still kind of looming there in terms of the worry around how that will impact supply chains and trade in and around North America? It's just a little bit blurred out by the bigger issues right now. How do you see that now?
Yeah, it's funny that it's I don't know if funny is the right word, but interesting that it's taken sort of a back seat because of everything else that's been going on. But it's still a hugely important development, particularly when you compare it to the requirements we had versus the legacy NAFTA program. So I do think for some companies, it's going to be a huge deal in terms of hitting the levels of compliance. But as I said earlier, I do think that the trend was already sort of swaying towards more localization of product in the supply chain. So I think that will help. But I think there are still going to be companies out there that are going to have some real challenges in meeting those requirements, and are going to have to perhaps accelerate their localization efforts. And again, in this environment, it's difficult, right? Because cash is tight and you're trying to save costs. That might not be the best economic move near term, but again, it's probably better than the consequences of not meeting the overall regulation. So I think that continues to loom large in the background for a lot of OEs and suppliers in the industry.
You're probably lucky that we're focusing more on North America, so I'll leave the Brexit question off of that side for now. We've got obviously some similar challenges here in terms of what's bigly lurking below the surface, let's say. Maybe last point, though, again, on the trade side. Clearly, there's also been rising tensions, US-China on the trade side, too. We've seen that impact on things like exports of premium vehicles from the US to China, perhaps also impacting on other plans we would have had from OEMs like Ford, who would have imported some models from China. Is this likely also to be having a pretty big impact over the coming years, or are we seeing, if you like, domestication in both sides of the market and supply chain?
So I think regardless of how things evolve regarding the trade relations between US and China going forward, I still think you'll see continued localization of product in both of those markets. But again, I think the presidential election in November will also play a big part to see how things play out. It's becoming increasingly difficult to kind of figure out where the wind is blowing related to trade relations these days. So obviously, I think at the end of the day, it's beneficial for everybody if relations are normalized and there's less hostility. It's better for the entire global supply chain. So I think ultimately we'll have to see what happens in November, and then any subsequent actions that happen by that administration to see what the impact will be.
Absolutely, and I think it's not just the automotive supply chain that would benefit from that in times of pandemic and crisis indeed. Well, yeah. I think that's a good point to end our discussion here, but obviously we have plenty of time coming up in the panel where we'll dig in a little bit further with a number of other experts. So I want to thank you, Brandon, for sharing this data and this insight. We'll pick up more in the Q&A, and for our audience as well. Use our networking tool to set up meetings and follow up more questions if you have. You've obviously put through some questions during this as well, which we'll do our best to address. So thanks again to Brandon. Thanks to everyone for tuning in, and we'll see you real soon.